Good day, and thanks for joining us here at the conference board for our special webcast on what we expect for economic growth in Europe in 2021 and beyond. So this morning, there's a few housekeeping rules you may have seen on the introductory slide, but certainly you can ask questions at the left-hand side in the chat box. You can certainly download the presentation from the download box, and don't forget to share this presentation with your colleagues. I'm sure you're going to find it interesting. With our special panel today, we have Ilaria Maselli, who's our chief economist in Europe, and Klaus de Vries, an economist also based in Brussels. So I'd like to get started right away on looking at the ground that we're going to cover this morning, right? So what we're really looking at is the impact of COVID-19 and its effect on the economy going forward. Will these November lockdowns derail this economy going into 2021? And what are the scenarios for growth next year? What's it going to look like, COVID and all? And what are the expectations of growth for the long term, for the rest of the decade? And how does growth in Europe compare to other geographies around the world, the U.S., China, etc.? So without further ado, let's turn it over to Klaus de Vries. Klaus?
Thanks, Chuck. So if we start with the mobility data, we can clearly see that November mobility went down quite a bit. So this is basically trips to grocery, to pharma, retail, recreation. This is data from Google. So you can see for all countries that there was starting from the end of October, early November, there was a big decline in mobility. And as you can see over the summer, it actually in a couple of countries returned to normal. But I think the big takeaway here is that while the declines were pretty severe, it was much lower compared to the spring lockdown, which is you can see on the most left-hand side here. And again, the countries are also relatively similar. Germany, for example, seems to have the lighter lockdown again as it was in spring, and countries like France, UK, and Italy were again among the more stringent countries. The only one that stands out a little bit is Spain, which seems to have a lighter lockdown, at least judging from the activity movements. Now, we have a model where we sort of break down GDP into a monthly cadence. As some of you know, GDP is released on a quarterly basis at least for most countries. And we use PMI data to sort of gauge, because GDP data of course comes out with a lag, so we use PMI data to see, to get a sort of heads up on a real-time estimate on monthly GDP. And based on the PMIs for November, we do see a slowdown in growth. So the November numbers are definitely lower than the October numbers. But as you can see here in the chart, we do expect the November slowdown to be much of a shallower nature than the one in spring. Now in the next slide, we put a number of indicators next to each other, so you can basically make your own judgment. So on the left-hand column we have the spring lockdown, and on the right-hand column we have the current lockdown. In the first block you see the mobility numbers. This is the earlier charts that I showed based on Google. And again, as you can see, the current decline in mobility is about half of what it was in spring. Now we get a slightly different picture from the PMIs. As you can see, they declined very severely in spring, basically here between February and April. Big declines in the PMI, and now we've seen that much less. From October to November, there was a decline. It was below 50 for a couple of countries, so that means below 50 means it's in contraction territory. There are more purchasing managers negative about growth than there are positive. But as you can see, there's a huge difference between the spring lockdown and the last. Yeah, and the last column shows you basically what we just described in the previous slide, the monthly GDP change, which is based on the PMI numbers. Sorry, Chuck.
No, I just think it's an interesting point. But where does the impact of the vaccine notion now come in? How do you see that impacting mobility? How do you see that in GDP growth going forward? A more optimistic view, perhaps.
Yeah, I think the mobility statistics are really, I think they are a sort of measure of what kind of restrictions the government puts in. And just to build on what I said before, it seems that with the current lockdown, governments have become better at restricting activity in such a way that the case numbers go down, but not in such a way that the economy is harmed. Of course, there are a couple of sectors which are doing not very well, but overall it seems that the government has become better at sort of managing this. I think the vaccine news so far doesn't play a large role in the current numbers. It will probably affect the expectations, right, and going forward. So if people have now in their mindset, maybe in 6 months' time, things will look very different. That, of course, changes expectations especially on big ticket items, right? Big ticket sales of big investments that households make, but also for business. So we do expect that to have a more positive effect in going forward.
Great, some light at the end of the tunnel, huh?
Yes, definitely. Yeah. So
We will actually come back to that. We will actually come back to that for 2021 when we look at the scenarios, because indeed that is, of course, one variable. But I agree with Klaas that right now it doesn't play a role. And despite that, actually, if I try to summarize the answer to the question, does the November lockdown derail the economy? I would say a little bit, in the sense that it's clear that GDP growth is negative in November to October, but by far not as negative as what it has been in March and April compared to the beginning of the lockdown. So let me go actually to another way of looking at this, which is from the point of view of CEOs and our members. And there was this interview in the FT, and I put here this quote from the CFO of IKEA, because I thought he really expressed well the feeling that we had already at the beginning of the November lockdown, which is the fact that it is a lockdown and there is, of course, huge restrictions to economic activity, but it's not the same in terms of coverage of services. It's not the same in terms of the land in many countries, how many weeks. And it's not the same also the capacity of members to continue doing business in a new way, in a different way, more online services, which it was difficult to put in place at the very beginning in March because we were all caught by surprise by the situation. So it is different from many reasons. And we capture that also with some numbers, and that's the CEO confidence. So let me perhaps explain that a bit. We have this survey of CEO. It's a measure of CEO confidence. In the US, it's something that we do 4 times a year. We do quarterly. In Europe, we do it twice a year. We just released for the second time. We started this year. And also our colleagues in the Gulf have just started, so they also just released their figures. So this is super updated because the survey was done in the second half of October. And what you see here is a measure that is well above 50, and basically it means that there are more positive than negative answers. So the measure is in Europe right now 61. In the US, it's a little bit higher, but it was also a little bit earlier. It was done at the end of September, the survey, so this might explain a little bit some difference. But there was a measure in particular of the 3 indicators that make up the survey. There is one in particular that has really influenced, and that's the fact that the assessment of the current situation is particularly positive compared to 6 months ago, and that's what is driving up the index. Not sure if you can still hear me, guys. Can you hear me?
Yes.
Okay. So I will continue because I heard a lot of silence and I wasn't sure if you could hear me. Perhaps I will just mention it was 34, if I remember well, the measure when we did the survey in May. So that was from 34 to 61. It's quite a big difference in terms of change. We have also other questions that are a little bit more specific on capital, employment, and sales. And I think we were actually surprised because on sales, CEOs were particularly positive. So the measure is 65 outside Europe and 60 for Europe. So for business in Europe and business outside Europe. Quite above 50, so more positive than negative views also when it comes to capital investment. And that was, I think, was the biggest surprise because, if you think about it, this is a moment of extreme uncertainty. And, it's very difficult to plan investment in a moment of extreme uncertainty. But at the same time, whenever we had other surveys, other research from the conference board, where we asked, okay, what's the priority right now? Everyone replied the digital transformation. And Chuck, you can help us there on the research I'm mentioning. And so I guess that, in a way, this very rare situation is in a way accelerating capital investment towards digital transformation. So that would be my interpretation of this result. And the one data point that comes out as particularly negative, unfortunately, this is not a surprise, it's employment. So looking ahead to the next 6 months, both in Europe and outside Europe, but much more in Europe, much more negative in Europe, CEOs have a rather negative expectation about employment.
Yeah, I think those are interesting numbers, and certainly we did our global survey back in June, looking at the long-term impacts, asking CEOs of the long-term impacts of COVID-19, and what came up was this notion around accelerating digital transformation within their organizations. So that's reassessing how you go to market. It's reassessing your business model. But the digital transformation notion, I think, is maybe tied to the employment numbers or the negativity around employment, in that CEOs also saw that more automation of routine tasks as part of the digital transformation notion. So I think that notion around capital investment, especially when it comes to digital transformation, and negativity around the employment numbers are fairly closely tied together. I think that's one of the longer-term legacies we'll see globally, not only in Europe. I think those are interesting points.
Okay, over to Klaas then, because.
Yeah, so if we move back to some of the earlier indicators we talked about. So if you look at the Purchasing Manager Index, for example, on the right-hand side, again, a level minus 50 means there's more negativity than positivity. And you can see here how the lockdown is sort of impacting much more the services sector than the manufacturing sector, which is still above 50 for the euro area. But the service sector, as you can see, has been declining. It's currently in contractionary territory. And that tells you, right, that a lot of the restrictions currently are mostly targeted to face-to-face services. A lot of the manufacturing activity can just continue as it did before. Now, another key variable in the current outlook are saving rates, which have gone up enormously in the first half of this year, as you can see on the left-hand side. A lot of that is probably driven by the fact that during the lockdowns, a lot of income was supported. So even though there was much less work to do, a lot of governments put in place job subsidy schemes, so people just kept getting paid. But a lot of shops were closed, a lot of spending opportunities were not there. So, and as a result, the saving rates have gone up a lot. The question is, of course, whether this is going to be a phenomenon that is just a one-off, or whether saving rates are coming down over the next year. obviously, on the one hand, this could be positive again with the vaccine news. If sentiment goes up, if expectations become better, then of course this extra savings may help to sort of smooth out the spending of consumers. Even though at some point job losses are going to come, of course. Bankruptcies have been very subdued so far, but that is also something that may still come. So this may be the high saving rates in the past may sort of help to keep consumption at a reasonable level. On the other hand, if this is something that is staying for a longer term, higher saving rates, perhaps not as high as it was in the first half, but if consumers are becoming more cautious on a longer term basis, that is obviously would have a negative impact on growth. So that is something that we'll need to watch closely. Now,
I think it's interesting just to look at that one point that Sweden, which had less of a severe lockdown, saving rates are declined year over year compared to.
Yeah, that's a good point. In Sweden, indeed, the restrictions were much lighter. It was really an outlier compared to the rest of Europe, even within the Nordic region. But still, the Swedish economy did also contract by quite a bit, but a lot of that was because the rest of Europe just didn't buy that many Swedish products. The domestic economy did much better in that sense. So yeah, that's an interesting point indeed. Now, I mentioned the manufacturing sector that is still sort of, at least based on the PMI data, seems to be going pretty strong still. We should, however, put some. I mean, there are more data points that give a sort of more mixed picture. If you look at, for example, the capacity utilization, the latest data at the start of Q4, so this is very recent, still suggests that the factories are still running at a much lower level as they were pre-pandemic. So it still tells you that there's still a lot of catch up to do. We think that a lot of this is much more in the consumer goods sector, which has recovered quickly, but a lot of the capital goods, much more related to business investment, which has not been doing very well recently. That especially that segment of manufacturing, the capital goods sector, is mostly behind this lower capacity utilization. Now, Ilaria, we talked a bit about vaccines and different scenarios. So, can you tell us a bit how do we view that in terms of the outlook for next year? What are the different options that we entertain?
Right, and I think this will also reply to some extent to the question I see here in the chat from Ravindra Rao about next year. So maybe I'll start with the short answer to that. The answer is no, in the sense that we see that we expect growth to be positive next year. Although quarter by quarter it's not clear how that is going to happen. Plus, I have to ask you if you can mute yourself because I hear myself twice and I can.
Sorry.
It's very difficult. So thank you. So we have learned, I think, especially at the beginning of September, that the pandemic can change course quite fast. And this is why we decided since summer basically to work with scenarios. We were in a way caught by surprise by the second wave because it happened faster and sooner than what we initially predicted during summer. So I think it's still useful, even though there are vaccines news and all, to still work with scenarios. So we have two. The first scenario is the base case scenario, which is more optimistic. So it's a scenario in which somehow COVID is controlled. It's a mix perhaps of vaccines and good treatment, and this leads to positive confidence, and fiscal stimulus pushes the economy up, limited employment losses. So it's a scenario where things go in a rather decent way and lead to a stronger growth in 2021. And then there is the downside scenario where there can be a lot of problems, for example, with the vaccine rolling out. I saw a survey, coming back to the question of Chuck, about there was a survey by Ipsos just a couple of weeks ago, I think, where they asked people when the vaccine is ready, will you take it within the first year, within a year? And there's still quite a few. There's quite a few people in Europe and in US, by the way, that say they would not take the vaccine, and the percentage is something like, let me look at my notes, 46% in France, 40% in Spain, 37% in the US. So that's not a small number. So things can go wrong with the vaccine, with the rolling out of the acceptance of the vaccine. Other lockdowns might be possible in the meantime. So this leads basically to a 2021 where the economy becomes, the recovery becomes very slow because it's affected by low confidence. Unemployment would increase a lot in the meantime. There can be problems with economic policy, both monetary and fiscal policy can make mistakes. So those are, I would say, both possible, but our bet currently is on the more optimistic scenario. So what does it mean in terms of numbers? Well, I will not give you a list of this and that growth in every country, but you can see here the trajectory of GDP levels. So if you take January of this year equal to 100, the exercise that is useful to do is really to say, okay, there was a gigantic drop, of course, in Q2, recovery in Q3. Right now, you can see that the economy is going down again in November. Where does it go from here? And so here you can see that the trajectory is different, because we expect in scenario one, the more optimistic scenario, the baseline, a steeper, a quicker recovery, such that basically by the end of next year, countries like Germany, France, and Italy close by, they reach 100, so they close the gap basically with the crisis. And UK and Spain, that are really deeply affected in this crisis, they don't reach 100, they stay somewhere around 97. But then there is the more pessimistic scenario where only Germany basically reaches 100, and then the other countries are below, and even below 95 in the case of Spain. So this means basically that in the case of scenario two, the economy remains affected for many quarters. It takes a long time for the economy not only to return to growth, but first of all to close the gap of the current recession.
And how do you think that impacts in the more longer run, looking out, for example, the next 5 or 10 years?
So we do this exercise once a year, where we run estimates for growth for the long term, for the next decade. And what we learned in this exercise is that really the way next year goes, the way 2021 goes, can really have an impact on the entire decade. So what you see here on these three lines is basically the dotted blue line is the estimate of last year. Pre-pandemic times, we had no idea this was going to happen a year ago. And so we did our normal, we ran our model and we say, okay, by the end of the decade, the euro area the GDP level will be equal to 120 if you consider the beginning of the decade around 100. So that was a bit the exercise. And you can see that, COVID has a big impact, of course. So in both scenarios, of course, the economy suffers for a long time because of the declining GDP of this year. And then depending how next year goes, it can be stronger or weaker. So right now we bet on the orange line so that we land in a better place that is not, of course, as good as if the pandemic didn't happen, but you can imagine it's impossible that the economy goes in such a huge shock and doesn't remain affected, because a lot of dynamics can start with the scarring of the economy, with people remaining in unemployment for a long time, with entire sectors, as you see the hospitality sector, that are affected for many years. So that is what explains the difference between the lines. Chuck, you have a strange face.
Yeah, Yeah, no, this raises a lot of questions. I know it's COVID all the time, right? To coin a phrase, if you will. But yeah, just wondering about other factors. I mean, we have the Brexit or no Brexit deal and change in administrations in the U.S. So I think there's a lot of things that start to impact that longer term next year and
I leave that one
beyond
to class
that are
because we did
outside
try
of
to
the COVID
simulate
sphere,
Brexit
if you
in those
will, right?
estimates.
Yeah, so in our modeling exercise, indeed, as Larry already mentioned, for the short term, we focus on this kind of monthly GDP industry-based model. But for the longer term, economic fundamentals tell you that it's mostly the underlying growth fundamentals, right? So the growth in labor, the growth in capital, and the growth in productivity. Those are in the longer term the drivers of economic activity. And basically in our model we have a number of variables that are linked to those growth factors. One of them is, for example, globalization, but we also have saving rates and a couple of other variables. So we took the opportunity to sort of play around with different scenarios. So what if, for example, globalization goes back to the 1970 levels, rather than I think we keep it constant for the projection horizon based on the current level. But what if we go back to the previous level? And then you can see it's actually a pretty substantial impact. So with sort of the status quo scenario, the next 10-year sort of euro area potential growth rate is around, let's say, 1.5, 1.6% annually, but with a globalization level from the 1970s that can go down as low as 1% or even lower on a yearly basis. So if you add that up, of course, that is a pretty significant impact to the productive capacity of the economy. Now, if we compare the euro area results to other mature economies, and again, I explained, right, when looking forward the next 10 years, we look at sort of the underlying drivers which are laid out here, and you can see that the euro area is sort of on a par with Japan in terms of expected GDP growth rates. It is a bit lower than the UK and especially the US, and as you can see on this chart, a lot of that comes from what we call the quantitative factors of growth. So especially in the US, there's still much more room for the labor supply to grow. There's more room for increasing the capital per worker rates. So that's the capital quantity ratio, basically. So that is a big difference why we think the euro area and Japan as well will grow a little bit slower than some of the other mature markets in the next decade.
So I guess we're getting close to time here. We were scheduled for half an hour. So going forward, for additional resources from the conference board, we have everything about the global economy that you may need to know, right? We do our monthly updates. We have a full suite of reports, all available online at the conference board.
Yes, definitely.
Larry, you may
we
know more
actually
about the
recorded
Indications
a
podcast series.
last week
That's your baby,
with
right?
class on the same subject. So it's if you listen to this webcast, you don't need to go to Indications podcast, but there is a lot of podcasts there on the economy, basically, and we try to really give regular updates, given the situation is changing so fast.
Right. And just to wrap up, do you have one thought about going forward? What do you think is the one thing that people should be looking out for when it comes to the impact on economy in the
I
future?
think
Are we happy? Are we
the
sad?
optimistic scenario
Are we
is
neutral?
very possible right now. I mean, you have to be prepared for everything, but I would say that the higher growth scenario that we described is still possible. But of course, that depends on how COVID goes, right? Because situation can change fast. That was the lesson in October in Europe. So yes, cautiously optimistic, like the CEO survey.
Yeah, I agree with Ilaria. I think the last couple of
Klaus?
weeks have shown some positive news, at least on the COVID situation. As you mentioned, there are other factors as well which need to be monitored closely. Fiscal policy, monetary policy, Brexit. I mean, there's still a lot of things that can go wrong. So we shouldn't stare only at the COVID situation. But there's definitely been some positive news recently that are good. Yeah.
Stay positive, test negative, right? Well, that's stay positive, test negative, right? That's what we want to. That's our notion, right? So when we just look, one more thing about it, we do have a pandemic hub. Everything from the economic side to human capital and governance, all available, all in looking at the short, medium, and long-term impacts of COVID-19. So I do recommend it. There's a lot of really interesting information on our COVID hub at the conference board. And finally, as we wrap up today, again, I want to say thanks for everyone for joining us. I hope you take away a positive attitude on this. What's going forward? We've all got our fingers crossed. So we're hoping for the best. And we'd like final thing to help us out is to let us know how we did. Tell us about your experience. If you just click on a short evaluation form, it'll take a couple of minutes to fill out. We'd really appreciate it so we can do better next time. So again, from the conference board, from Ilaria, from Klaus, I'd like to say thank you for joining us, and we'll see you at our next one.